Question 1. Process analysis reveals that an organization's cybersecurity posture is being undermined by a lack of structured vulnerability management. As an accredited advisor in management AAM, you are tasked with improving this situation. Which of the following approaches best aligns with the regulatory framework and ethical obligations for an AAM in identifying and mitigating vulnerabilities? Option A. Implement a comprehensive vulnerability management program that includes regular identification, risk-based prioritization of vulnerabilities, development of remediation plans with assigned responsibilities and timelines, and verification of fixes. Option B. Adopt a reactive strategy, addressing vulnerabilities only when they are actively exploited and lead to security incidents. Option C. Focus primarily on documenting all identified vulnerabilities, creating a detailed inventory without establishing formal remediation processes or timelines. Option D. Prioritize the remediation of vulnerabilities based on which ones are easiest and quickest to fix, regardless of their potential impact or likelihood of exploitation. Correct answer is A. Implement a comprehensive vulnerability management program that includes regular identification, risk-based prioritization of vulnerabilities, development of remediation plans with assigned responsibilities and timelines, and verification of fixes. Explanation. This scenario presents a professional challenge because the accredited advisor in management AAM is tasked with implementing a robust vulnerability management program within a complex organizational structure, where resource constraints and competing priorities can hinder effective execution. The core difficulty lies in balancing the proactive identification and mitigation of vulnerabilities with the day-to-day operational demands, and the need to demonstrate tangible value to stakeholders. Careful judgment is required to prioritize actions, allocate resources judiciously, and ensure that the program aligns with the organization's overall risk appetite and strategic objectives, all while adhering to the relevant regulatory framework. The correct approach involves establishing a systematic process for identifying, assessing, prioritizing, and remediating vulnerabilities. This includes regular scanning, penetration testing, and threat intelligence gathering to uncover potential weaknesses. Crucially, it mandates the development of clear remediation plans with defined timelines and assigned responsibilities, followed by rigorous verification of fixes. This approach is ethically and regulatorily sound because it directly addresses the AAM's duty of care to protect the organization's assets and data from harm. It aligns with principles of good governance and risk management, which are fundamental to the AAM designation. By proactively managing vulnerabilities, the AAM demonstrates a commitment to maintaining the integrity and security of the organization's systems and information, thereby fulfilling their professional obligations. An incorrect approach that focuses solely on identifying vulnerabilities without a clear plan for mitigation fails ethically and regulatorily. This oversight neglects the proactive duty to protect, leaving the organization exposed to known risks. Such an approach could be seen as a dereliction of professional responsibility, as identifying a problem without taking steps to resolve it is insufficient. Another incorrect approach that prioritizes remediation based solely on the perceived ease of implementation, rather than the severity of the vulnerability and its potential impact, is also professionally unacceptable. This can lead to critical vulnerabilities being overlooked or addressed too late, exposing the organization to significant harm. It demonstrates a lack of sound risk assessment and prioritization, which are core competencies for an AAM. A further incorrect approach that relies on ad hoc, reactive measures to address vulnerabilities only after an incident has occurred is fundamentally flawed. This reactive stance is contrary to the principles of effective vulnerability management and good governance. It indicates a failure to implement a proactive security posture, which is a key expectation for an AAM and a requirement under many regulatory frameworks that mandate risk mitigation. Professionals should employ a decision-making framework that begins with understanding the organization's specific context, including its risk appetite, regulatory obligations, and available resources. This should be followed by a systematic assessment of potential vulnerabilities, their likelihood of exploitation, and their potential impact. Prioritization should then be based on a risk-based methodology, focusing on the most critical threats. The implementation of remediation plans must be tracked and verified, with continuous monitoring and adaptation of the program to evolving threat landscapes. This structured, risk-informed and proactive approach ensures compliance and upholds professional standards. Question 2. The performance metrics show a consistent decline in customer satisfaction scores over the last 2 quarters, alongside an increase in average customer complaint resolution time. The client's stated objective is to maintain a market-leading customer experience. Which of the following approaches best addresses this situation? Option A. Immediately implement a new, more stringent performance management system for customer service staff, with significant penalties for failing to meet new, aggressive targets for complaint resolution. Option B. Recommend a significant reduction in customer service staff to cut costs, arguing that the current metrics indicate an inefficient operation that needs streamlining. Option C. Conduct a comprehensive review of customer service processes, including agent training, technology utilization, and complaint escalation procedures, to identify specific bottlenecks and areas for improvement, and then propose targeted interventions. Option D. Focus solely on reducing the average complaint resolution time by outsourcing a portion of the customer service function to a lower-cost provider, without assessing the impact on overall customer satisfaction. The correct answer is C. Conduct a comprehensive review of customer service processes, including agent training, technology utilization, and complaint escalation procedures, to identify specific bottlenecks and areas for improvement, and then propose targeted interventions. Explanation. This scenario presents a common challenge in management advisory roles, interpreting performance data and recommending appropriate corrective actions. The professional challenge lies in moving beyond a superficial observation of metrics to a nuanced understanding of underlying causes, ensuring that proposed actions are not only effective, but also compliant with the Accredited Adviser in Management (AAM) regulatory framework and ethical guidelines. A key aspect is the advisor's duty to act in the best interest of the client, which requires a thorough, evidence-based approach to performance evaluation and intervention. The correct approach involves a systematic analysis of the performance metrics to identify deviations from established benchmarks or objectives. This includes investigating the root causes of any underperformance, considering both internal operational factors and external market influences. Once causes are identified, the advisor must recommend corrective actions that are proportionate, feasible, and aligned with the client's strategic goals. This approach is justified by the AAM's emphasis on professional competence, due diligence, and the obligation to provide sound, actionable advice. Ethical considerations mandate that recommendations are objective and free from bias, prioritizing the client's long-term success. An incorrect approach would be to immediately implement drastic punitive measures without a thorough investigation. This fails to address the root cause of the performance issue and could lead to unintended negative consequences, such as decreased employee morale or operational disruption, without resolving the underlying problem. Such an approach breaches the AAM's requirement for evidence-based decision-making and professional judgment. Another incorrect approach is to focus solely on superficial symptoms of underperformance, such as a single negative metric, without understanding the broader context or interdependencies within the business. This superficial analysis can lead to misdiagnosis and the implementation of ineffective or even counterproductive solutions. It demonstrates a lack of due diligence and professional competence. A further incorrect approach involves recommending actions that are not aligned with the client's strategic objectives or resource capabilities. This demonstrates a failure to understand the client's business and its operational realities, leading to recommendations that are impractical or unlikely to achieve the desired outcomes. This violates the AAM's principle of providing relevant and valuable advice. The professional decision-making process for similar situations should involve a structured approach. 1. Data gathering and validation. Ensure all performance data is accurate and complete. 2. Root cause analysis. Employ diagnostic tools and techniques to understand why performance deviates. 3. Stakeholder consultation. Engage with relevant internal stakeholders to gain insights and perspectives. 4. Solution development. Brainstorm and evaluate potential corrective actions based on their effectiveness, feasibility, and alignment with strategic goals. 5. Recommendation and implementation planning. Clearly articulate the recommended actions, their rationale, and a phased implementation plan. 6. Monitoring and review. Establish mechanisms to track the effectiveness of implemented actions and make adjustments as needed. Question 3. Comparative studies suggest that designing competitive pay and benefit packages for management roles is crucial for talent acquisition and retention. An accredited advisor in management, AAM, is tasked with advising a mid-sized technology firm on updating its executive compensation structure. The firm has experienced rapid growth, but is concerned about retaining its key leadership talent amidst increasing industry competition. Considering the AAM's professional obligations and the need for a sustainable and ethical compensation strategy, which of the following approaches best aligns with regulatory frameworks and professional best practices for this scenario? Option A. Propose a compensation package that mirrors the top 10% of compensation observed among comparable technology firms, prioritizing immediate attraction of talent, with a review scheduled only after 3 years. Option B. Develop a compensation and benefits package that is benchmarked against industry averages, ensuring all components are compliant with current employment legislation and the AAM Code of Ethics, with a focus on a balanced mix of base salary, performance-based incentives, and comprehensive benefits that align with the firm's financial capacity and strategic objectives. Option C. Advise the firm to offer a discretionary bonus pool that can be allocated by the CEO based on perceived individual performance, without establishing clear, objective performance metrics or a formal review process for the allocation. Option D. Recommend a compensation structure heavily weighted towards stock options and long-term incentives, as this is a common practice in the tech industry, without a detailed analysis of the firm's current cash flow or the potential dilutive effects on existing shareholders. The correct answer is A. Propose a compensation package that mirrors the top 10% of compensation observed among comparable technology firms, prioritizing immediate attraction of talent, with a review scheduled only after 3 years. Explanation. Scenario analysis. Designing competitive pay and benefit packages for management roles presents a significant professional challenge. Advisors must balance the organization's financial health and strategic objectives with the need to attract, retain, and motivate high-caliber talent. This requires a nuanced understanding of market dynamics, legal compliance, and ethical considerations, particularly concerning fairness and transparency in compensation. The risk of inadvertently creating pay disparities or non-compliant benefit structures necessitates a rigorous and informed approach. Correct approach analysis. The correct approach involves a comprehensive review of the organization's current compensation and benefit structure against relevant market benchmarks, and crucially, against the Accredited Adviser in Management (AAM) Code of Ethics and any applicable regulatory guidelines. This includes ensuring that all proposed compensation and benefit elements are transparent, equitable, and do not create undue financial strain on the organization. Specifically, the AAM Code of Ethics emphasizes integrity, objectivity, and professional competence. Therefore, a process that prioritizes data-driven analysis, legal compliance, and ethical considerations, such as ensuring no discriminatory practices are embedded in the package, aligns with these principles. This approach fosters trust and sustainability. Incorrect approach is analysis. An approach that solely focuses on replicating the highest compensation packages observed in competitor organizations, without considering the organization's specific financial capacity or strategic goals, is professionally unsound. This can lead to unsustainable cost structures and potentially violate principles of financial prudence. Furthermore, an approach that prioritizes anecdotal evidence or personal relationships over objective data and regulatory compliance risks introducing bias and unfairness, contravening the AAM's commitment to objectivity and integrity. Another incorrect approach would be to implement a package that, while appearing competitive, contains benefit components that are not compliant with local employment laws or industry-specific regulations, thereby exposing the organization to legal and reputational risks. This demonstrates a failure in professional competence and due diligence. Professional reasoning. Professionals tasked with designing compensation and benefit packages should adopt a systematic, data-driven, and ethically grounded decision-making process. This involves 1. Understanding the client's strategic objectives and financial constraints. 2. Conducting thorough market research to identify competitive benchmarks. 3. Ensuring strict adherence to all relevant legal and regulatory frameworks. 4. Applying the principles of fairness, transparency, and equity in package design. 5. regularly reviewing and updating packages to maintain competitiveness and compliance. This structured approach mitigates risks and ensures that compensation strategies effectively support organizational goals while upholding professional standards. Question 4. Market research demonstrates a significant and growing demand for advisory services in several nascent technological sectors. To effectively serve this emerging client base, an accredited advisor in management (AAM) firm needs to organize its operations to leverage specialized knowledge while maintaining efficient resource allocation and clear accountability. Which organizational approach best supports the firm's ability to provide expert, compliant, and client-centric advisory services in these new domains? Option A. Assign project leadership for all emerging market research initiatives to the most senior managers in the firm, prioritizing general management experience over specific expertise in the technological sectors being researched. Option B. Centralize all decision-making authority for emerging market research within a single, broad innovation department staffed by generalist managers, irrespective of their specific technological sector expertise. Option C. Implement a matrix organizational structure where project teams are formed to address specific emerging market sectors, drawing expertise from functional departments e.g., technology analysis, financial modeling, regulatory compliance, while maintaining clear functional reporting lines for standards and development. Option D. Create entirely separate, independent, emerging sector units, each fully responsible for all aspects of research and advisory within its designated niche, with minimal interaction or shared resources between units. The correct answer is C. Implement a matrix organizational structure where project teams are formed to address specific emerging market sectors, drawing expertise from functional departments, e.g., technology analysis, financial modeling, regulatory compliance, while maintaining clear functional reporting lines for standards and development. Explanation. This scenario is professionally challenging because it requires balancing the need for specialized expertise with the imperative of efficient resource allocation and clear lines of authority, all within the specific regulatory framework governing accredited advisors in management (AAM). The AAM designation implies a commitment to professional standards that prioritize client interests and regulatory compliance. The core challenge lies in designing an organizational structure that fosters innovation and deep knowledge in emerging areas, while ensuring that decision-making remains streamlined and accountable, preventing potential conflicts of interest or regulatory breaches. The correct approach involves establishing a matrix structure where specialized project teams can draw upon functional expertise. This structure allows for the efficient deployment of highly skilled individuals to specific projects, fostering innovation and deep dives into niche market segments. From a regulatory perspective, this approach aligns with the AAM's duty to provide competent advice. By creating dedicated teams with clear reporting lines for project-specific tasks and functional oversight, it ensures that expertise is leveraged effectively without diluting overall accountability. This structure supports the AAM's obligation to maintain professional competence and to act in the best interests of clients by ensuring that advice is informed by the most relevant and up-to-date knowledge. It also facilitates better risk management by allowing for focused oversight within project teams while maintaining broader functional standards. An approach that centralizes all decision-making within a single, broad functional department, regardless of the specific expertise required for emerging market research, is incorrect. This would likely lead to bottlenecks, a lack of specialized knowledge being applied to critical decisions, and potentially slower response times to market shifts. Ethically, it fails to leverage the full capabilities of the advisory team and could result in suboptimal advice to clients, thereby not acting in their best interests. It also risks creating a situation where individuals lack the specific expertise to make informed decisions, potentially leading to regulatory noncompliance due to a failure in due diligence. Another incorrect approach would be to create entirely separate, siloed departments for each emerging market segment, without any overarching functional integration or shared resource pool. While this might foster deep expertise within each silo, it would be inefficient, lead to duplication of effort, and make it difficult to share best practices or cross-pollinate ideas. This fragmentation could also obscure lines of accountability and make it harder to ensure consistent application of overarching professional standards and regulatory requirements across the organization. It could also lead to a lack of strategic alignment, as each silo might pursue its own objectives without considering the broader organizational goals or client needs. A third incorrect approach would be to assign project leadership to individuals based solely on seniority or general management experience, without regard for their specific expertise in the emerging market segment being researched. This would undermine the value of specialized knowledge and could lead to decisions being made by individuals who lack the necessary understanding of the nuances of the market. This directly contravenes the AAM's obligation to provide competent advice and could expose the firm and its clients to significant risks, potentially leading to regulatory sanctions for providing advice that is not based on sound expertise. The professional decision-making process for similar situations should involve a thorough assessment of the specific needs of the emerging market research, the available expertise within the advisory team, and the regulatory requirements for competent advice and client best interests. This includes evaluating different organizational structures for their ability to foster specialization, ensure efficient resource allocation, maintain clear lines of accountability, and facilitate effective decision-making. The chosen structure must demonstrably support the delivery of high-quality, compliant advice that prioritizes client outcomes. Question 5. Investigation of the recruitment and selection process for a new senior management position within an organization, considering the perspectives of attracting and hiring qualified employees. What approach best aligns with regulatory compliance and ethical best practices for an accredited advisor in management AAM? Option A. Developing a detailed job specification outlining essential skills, experience, and qualifications, advertising the role widely through professional networks and industry-specific platforms, and utilizing a structured interview process with predefined assessment criteria to evaluate candidates objectively. Option B. Conducting a series of casual, unstructured conversations with potential candidates, making hiring decisions based on personal rapport and perceived cultural fit without formal assessment or verification of qualifications. Option C. Focusing recruitment efforts on individuals who possess a very specific and niche skill set, even if it means significantly limiting the applicant pool, and assuming that extensive prior experience in that exact niche is the sole indicator of success. Option D. Primarily relying on recommendations from existing senior staff, with a brief informal discussion to gauge suitability, and prioritizing candidates who are known to the hiring manager. The correct answer is A. Developing a detailed job specification outlining essential skills, experience, and qualifications, advertising the role widely through professional networks and industry-specific platforms, and utilizing a structured interview process with predefined assessment criteria to evaluate candidates objectively. Explanation. This scenario presents a professional challenge because the accredited advisor in management AAM must balance the immediate need for skilled personnel with the long-term implications of their recruitment and selection processes. The challenge lies in ensuring that the methods used to attract and hire qualified employees are not only effective in filling roles, but also compliant with relevant regulatory frameworks and ethical standards, particularly concerning fairness, transparency, and data privacy. A robust recruitment strategy must consider the perspectives of all stakeholders, including potential candidates, existing employees, the organization, and regulatory bodies. The correct approach involves a comprehensive strategy that prioritizes attracting a diverse pool of qualified candidates through clear and accurate job descriptions, leveraging multiple recruitment channels, and employing objective selection criteria. This approach is ethically sound and aligns with best practices for fair employment. Specifically, it adheres to principles of equal opportunity by not discriminating based on protected characteristics and ensures transparency by providing realistic job previews. This proactive and inclusive method fosters a positive employer brand, reduces the risk of legal challenges, and ultimately leads to better long-term employee retention and organizational performance. An incorrect approach that relies solely on internal referrals without broader advertising or objective assessment fails to meet regulatory requirements for equal opportunity and can lead to a lack of diversity and potential for unconscious bias. This method may overlook highly qualified external candidates and can create perceptions of favoritism, undermining employee morale and the organization's reputation. Another incorrect approach that focuses exclusively on candidates with specific, narrow qualifications without considering transferable skills or potential for development can limit the talent pool and hinder innovation. This can also lead to a workforce that is not adaptable to changing business needs and may inadvertently exclude individuals who could bring valuable perspectives. A third incorrect approach that involves making hiring decisions based on informal interviews and subjective impressions without structured assessment or reference checks is highly susceptible to bias and lacks the rigor required for defensible hiring decisions. This can result in poor hiring choices, increased turnover, and potential legal repercussions due to discriminatory practices. Professionals should employ a decision-making framework that begins with a thorough understanding of the role's requirements and the organization's strategic objectives. This should be followed by designing a recruitment process that is compliant with all applicable laws and ethical guidelines, ensuring fairness, transparency, and objectivity at every stage. Regular review and evaluation of the recruitment process are crucial to identify areas for improvement and to ensure continued adherence to best practices and regulatory standards. Question 6. The performance metrics show a significant divergence in profitability across subsidiaries within a multinational group, prompting a review of intercompany service agreements. As an accredited advisor in management AAM, what is the most appropriate initial step to ensure compliance with transfer pricing regulations when determining the arm's length remuneration for these services? Option A. Select a transfer pricing method that has historically been used by the group, assuming it remains relevant and compliant with current regulatory expectations. Option B. Propose a cost-plus markup for all intercompany services that is consistent with industry averages, without detailed analysis of the specific services or benefits. Option C. Conduct a detailed functional analysis of each subsidiary to understand the specific services provided, the benefits received, and the risks assumed by each entity, and then identify the most appropriate transfer pricing method based on this analysis. Option D. Focus solely on minimizing the overall tax liability for the group by applying the lowest possible markup on services, irrespective of the functional analysis or regulatory requirements. The correct answer is C. Conduct a detailed functional analysis of each subsidiary to understand the specific services provided, the benefits received, and the risks assumed by each entity, and then identify the most appropriate transfer pricing method based on this analysis. Explanation. This scenario is professionally challenging because it requires an accredited advisor in management AAM to navigate the complexities of transfer pricing within the specific regulatory framework governing their practice, likely focusing on principles of arm's length transactions and documentation requirements. The advisor must balance the client's desire for tax efficiency with the imperative to comply with regulations, ensuring that intercompany transactions are priced as if they were between independent parties. The core challenge lies in selecting and applying the most appropriate transfer pricing method, which demands a thorough understanding of the business operations, the functions performed, assets employed, and risks assumed by each entity involved. The correct approach involves a comprehensive functional analysis to identify the most comparable uncontrolled transactions or companies. This method, often referred to as the comparable uncontrolled price (CUP) method when applicable, or other recognized methods like the resale price method (RPM), cost-plus method (CPM), transactional net margin method (TNMM), or profit split method (PSM), requires robust documentation to support the chosen method and the resulting pricing. The regulatory framework for AAMs, assuming it aligns with international best practices such as OECD guidelines, mandates that transfer prices reflect the arm's length principle. This means the chosen method must be the most reliable indicator of what independent parties would agree to under similar circumstances. The advisor's duty is to ensure the client's transfer pricing policies are defensible, transparent, and compliant, thereby mitigating the risk of tax adjustments, penalties, and reputational damage. An incorrect approach would be to arbitrarily select a transfer pricing method without conducting a thorough functional analysis. For instance, choosing a method solely because it appears to yield the most favorable tax outcome for the group, without regard to its economic substance or comparability to arm's length transactions, would be a regulatory and ethical failure. This bypasses the fundamental principle of arm's length pricing and could be seen as aggressive tax planning, potentially violating anti-avoidance rules. Another incorrect approach would be to rely on outdated or insufficient documentation. Regulations typically require contemporaneous documentation that clearly explains the chosen method, the analysis performed, and the data used to support the arm's-length nature of the intercompany transactions. Failing to provide this can lead to challenges from tax authorities and penalties. The professional reasoning process for an AAM in such a situation should involve a systematic evaluation of the client's intercompany transactions. This begins with understanding the business and the specific transactions. Next, a detailed functional analysis is crucial to identify the contributions of each entity. Based on this analysis, the advisor should identify potential transfer pricing methods and assess their applicability and reliability, considering the availability of comparable data. The most appropriate method should then be selected and applied, with meticulous documentation prepared to support the arm's-length outcome. Regular review and updates of the transfer pricing policies are also essential to reflect changes in the business or economic conditions. Question 7. System analysis indicates that an accredited advisor in management AAM is advising a client who wishes to understand the future value of a specific investment portfolio in 10 years. The client has provided the current investment amount and expects a certain annual rate of return. The AAM needs to communicate the potential outcome to the client. Which of the following best describes the most appropriate approach for the AAM to take, considering the principles of time value of money and regulatory expectations for financial advice? Option A. State the current investment amount and inform the client that this is the value they will have in 10 years, as future projections are uncertain. Option B. Provide a future value calculation using an exceptionally high speculative growth rate to demonstrate the maximum possible outcome without detailing the assumptions. Option C. Calculate the projected future value of the investment based on the provided information and clearly explain what this figure represents in terms of the investment's potential growth over the specified period. Option D. Focus solely on the initial investment cost and advise the client that the primary goal is to preserve this capital, disregarding any potential for growth or future value. The correct answer is C. Calculate the projected future value of the investment based on the provided information and clearly explain what this figure represents in terms of the investment's potential growth over the specified period. Explanation. This scenario presents a professional challenge because it requires an accredited advisor in management AAM to balance the immediate financial needs of a client with the long-term implications of investment decisions, all while adhering to strict regulatory requirements. The core of the challenge lies in accurately assessing the future value of an investment to inform a present decision, which is susceptible to misinterpretation or oversimplification without a thorough understanding of the time value of money (TVM) principles and their regulatory context. Careful judgment is required to ensure advice is not only financially sound, but also compliant and ethically responsible. The correct approach involves recognizing that the client's request for a lump sum payment in the future, based on an investment's projected growth, necessitates a clear understanding of its present value. This means discounting future cash flows back to their current worth, considering appropriate discount rates that reflect risk and opportunity cost. This approach aligns with the AAM's duty to provide advice that is in the client's best interest, grounded in sound financial principles, and compliant with regulatory expectations regarding financial planning and investment advice. Specifically, regulatory frameworks for financial advisors typically mandate that advice must be suitable, well-researched, and clearly communicated, ensuring clients understand the implications of their financial decisions. Presenting a future value without considering its present worth can be misleading, as it doesn't accurately reflect the purchasing power or investment required today to achieve that future sum. An incorrect approach would be to simply state the projected future value of the investment without any context of its present worth or the implications of receiving it at a future date. This fails to acknowledge the core principle of TVM, where money available today is worth more than the same amount in the future due to its earning potential. Ethically, this is a failure of due diligence and transparency, as it omits crucial information that a client needs to make an informed decision. From a regulatory standpoint, this could be seen as providing incomplete or misleading advice, potentially violating rules that require advisors to act in the client's best interest and ensure suitability of recommendations. Another incorrect approach would be to focus solely on the initial investment amount and ignore any projected growth or the time horizon. This demonstrates a fundamental misunderstanding of investment principles and TVM. It fails to provide the client with any meaningful projection of their potential returns, rendering the advice practically useless for future planning. This approach is ethically deficient as it does not fulfill the advisor's obligation to provide comprehensive and relevant financial guidance. Regulatory bodies would likely view this as a failure to provide competent advice, as it lacks any forward-looking analysis. A third incorrect approach would be to present a future value calculation that uses an overly optimistic or unrealistic growth rate without proper justification or disclosure of assumptions. While TVM calculations are forward-looking, the accuracy of the future value is highly dependent on the chosen rate of return. Using an unsubstantiated high rate can create false expectations for the client. This is a significant ethical breach, as it misrepresents potential outcomes and can lead to poor financial decisions. Regulatory frameworks often require advisors to use reasonable assumptions and to clearly disclose the basis for any projections, especially when they are significantly optimistic. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the client's objective. Clearly define what the client wants to achieve in the time frame. 2. Identify relevant financial principles. Recognize the applicability of TVM concepts like present value and future value. 3. Gather necessary data. Obtain all relevant information about the investment, including initial costs, expected cash flows, and the time horizon. 4. Apply appropriate methodologies. Use sound financial calculations, considering realistic discount and growth rates. 5. Analyze and interpret results. Understand the implications of the calculations in the context of the client's goals and risk tolerance. 6. Communicate clearly and transparently. Explain the findings to the client in an understandable manner, disclosing all assumptions and potential risks. 7. Ensure regulatory compliance. Verify that the advice and the communication thereof meet all applicable regulatory standards and ethical obligations. Question 8. The review process indicates that the organization's training and development budget is under significant pressure due to recent economic downturns. The Accredited Adviser in Management (AAM) is tasked with recommending strategies to enhance employee skills and knowledge while adhering to strict cost-saving measures. Which of the following approaches best balances the need for skill development with financial prudence, aligning with professional ethical obligations? Option A. Immediately cease all external training programs and rely exclusively on informal on-the-job learning to reduce immediate training costs. Option B. Implement a comprehensive skills gap analysis to identify critical areas for development. Then design a blended learning strategy that combines cost-effective internal mentoring and workshops with targeted, high-impact external training for specialized roles, prioritizing return on investment for all expenditures. Option C. Invest in the cheapest available online training modules for all employees, regardless of specific skill needs or the perceived quality of the content. Option D. Eliminate the entire training and development budget for the next fiscal year to demonstrate significant cost savings. The correct answer is B. Implement a comprehensive skills gap analysis to identify critical areas for development. Then design a blended learning strategy that combines cost-effective internal mentoring and workshops with targeted, high-impact external training for specialized roles, prioritizing return on investment for all expenditures. Explanation. This scenario presents a professional challenge because it requires balancing the immediate need for cost containment with the long-term strategic imperative of developing a skilled and adaptable workforce. The Accredited Adviser in Management (AAM) has a fiduciary duty to act in the best interests of the client organization, which includes ensuring its human capital is optimized for current and future success. A purely cost-driven decision, without considering the impact on employee capabilities and organizational performance, would be short-sighted and potentially detrimental. The regulatory framework for AAMs emphasizes ethical conduct, professional competence, and the pursuit of sustainable business practices. The correct approach involves a comprehensive assessment of training needs, aligning them with strategic objectives, and then evaluating cost-effective yet impactful development solutions. This demonstrates a commitment to professional competence by ensuring that training is relevant and contributes to enhanced employee skills and knowledge, ultimately benefiting the organization. It also aligns with ethical principles by prioritizing the long-term health and capability of the organization over short-term financial gains that could compromise future performance. An incorrect approach that focuses solely on eliminating all external training to reduce immediate costs fails to recognize the critical role of continuous learning in maintaining competitiveness and adapting to market changes. This approach risks skill obsolescence, reduced employee morale, and a decline in innovation, all of which can negatively impact the organization's long-term viability. Ethically, it can be seen as a failure to uphold professional competence and to act in the best interests of the client by neglecting a key driver of organizational success. Another incorrect approach that prioritizes the cheapest available training without regard for quality or relevance is also professionally unsound. While seemingly cost-effective, such training may be ineffective, leading to wasted resources and a failure to achieve desired skill enhancements. This can result in a lack of return on investment and a continued gap in employee capabilities, undermining the organization's strategic goals. This approach demonstrates a lack of due diligence and a failure to apply professional judgment in selecting appropriate development interventions. A further incorrect approach that relies solely on informal on-the-job learning without structured development programs may not be sufficient to address complex skill gaps or to foster specialized knowledge. While informal learning is valuable, it often lacks the systematic approach required for targeted skill development and may not provide the depth of knowledge or standardized competencies needed for certain roles or future challenges. This can lead to inconsistent skill levels across the workforce and a missed opportunity for structured knowledge transfer. The professional decision-making process for similar situations should involve a structured needs analysis, linking training requirements to organizational strategy, exploring a range of development options, internal, external, blended, evaluating their cost-effectiveness and potential impact, and then making a recommendation based on a holistic assessment of benefits and risks. This process ensures that decisions are informed, ethical, and aligned with the long-term interests of the client. Question 9. Compliance review shows that a client has engaged in a complex series of transactions involving the sale of assets with a significant repurchase agreement. While two different accounting treatments are arguably permissible under generally accepted accounting principles, GAAP, one treatment more accurately reflects the economic substance of the transaction as a financing arrangement rather than a true sale. As an accredited advisor in management AAM, which approach should you advocate for in the client's financial statements? Option A. Advocate for applying different accounting treatments to similar components of the transaction to maximize flexibility in reporting. Option B. Advocate for the accounting treatment that presents the most favorable immediate financial results for the client, provided it can be technically justified under a plausible interpretation of GAAP. Option C. Advocate for the accounting treatment that most faithfully represents the economic substance of the transaction, even if it results in a less favorable immediate financial presentation, and ensure full disclosure of the accounting policy. Option D. Advocate for the accounting treatment that is simpler to apply, even if it does not fully capture the economic reality of the transaction. The correct answer is C. Advocate for the accounting treatment that most faithfully represents the economic substance of the transaction, even if it results in a less favorable immediate financial presentation, and ensure full disclosure of the accounting policy. Explanation. This scenario presents a professional challenge because it requires an accredited advisor in management AAM to navigate differing interpretations of generally accepted accounting principles, GAAP, when preparing financial statements for a client. The core difficulty lies in ensuring that the chosen accounting treatment is not only compliant with GAAP, but also presents a true and fair view of the client's financial position, while also considering the potential for misinterpretation or manipulation. The advisor must exercise professional skepticism and judgment to determine the most appropriate application of GAAP in a situation where ambiguity exists. The correct approach involves selecting the accounting treatment that most faithfully represents the economic substance of the transactions, even if another interpretation might be technically permissible under GAAP. This aligns with the overarching objective of GAAP, which is to provide users of financial statements with relevant and reliable information. Specifically, adherence to the principle of substance over form is paramount. This means that the accounting treatment should reflect the economic reality of the transaction rather than its legal form. Furthermore, The advisor must ensure that the chosen method is consistently applied and adequately disclosed in the financial statements, allowing users to understand the basis of accounting. This approach upholds the integrity of financial reporting and the AAM's professional responsibility. An incorrect approach would be to adopt the accounting treatment that results in a more favorable financial outcome for the client, even if it is less representative of the economic reality. This could involve selecting an accounting policy that is technically allowed by GAAP, but obscures the underlying financial performance or position. Such an approach violates the principle of faithful representation and could mislead users of the financial statements. Another incorrect approach would be to apply different accounting treatments to similar transactions within the same reporting period without adequate justification, thereby compromising the comparability and consistency of the financial information. This failure to maintain consistency and comparability is a direct contravention of fundamental accounting principles. A further incorrect approach would be to avoid disclosing the accounting policy chosen when there is a clear alternative, thereby preventing users from understanding the basis of the financial statements and potentially leading to misinterpretation. The professional reasoning process for similar situations should involve a thorough understanding of the specific GAAP pronouncements applicable to the transaction. The advisor must then critically evaluate the economic substance of the transaction and consider how different accounting treatments would reflect that substance. Seeking clarification from accounting standard setters or professional bodies, if necessary, is also a prudent step. Ultimately, the decision should be guided by the principle of presenting a true and fair view, supported by robust disclosure and consistent application of accounting policies. Question 10. Assessment of the process optimization strategy for managing accounts payable, notes payable, and bonds payable within an organization, focusing on its impact on regulatory compliance and the accuracy of financial reporting. Option A. Implementing enhanced internal controls and automated workflows for invoice verification, authorization, and payment processing, alongside rigorous reconciliation procedures for all payable accounts, and ensuring timely and accurate recording and disclosure of all notes and bonds payable, including accrued interest and covenant compliance. Option B. Streamlining the payment process by authorizing immediate payment of all incoming invoices upon receipt to expedite cash outflow and improve supplier relations, with a secondary focus on reconciling payable accounts at year-end. Option C. Deferring the recording of new notes and bonds payable until the end of the fiscal quarter to simplify interim reporting, and consolidating the disclosure of all debt instruments into a single summary line item. Option D. Focusing solely on reducing the average payment period for accounts payable to maximize early payment discounts, without establishing comprehensive verification procedures for the underlying invoices. The correct answer is A. Implementing enhanced internal controls and automated workflows for invoice verification, authorization, and payment processing, alongside rigorous reconciliation procedures for all payable accounts, and ensuring timely and accurate recording and disclosure of all notes and bonds payable, including accrued interest and covenant compliance. Explanation. This scenario is professionally challenging because it requires an accredited advisor in management (AAM) to balance the imperative of accurate financial reporting with the practicalities of managing operational efficiency when dealing with accounts payable, notes payable, and bonds payable. The core tension lies in ensuring that liabilities are recognized and disclosed appropriately according to the relevant regulatory framework, while also considering the impact of process optimization on the accuracy and timeliness of this recognition. Failure to adhere to the regulatory framework can lead to misstated financial statements, potential regulatory sanctions, and erosion of stakeholder trust. The correct approach involves a systematic review and enhancement of internal controls and processes related to the entire life cycle of payables, from invoice receipt to payment and reconciliation. This includes implementing robust verification procedures for all incoming invoices, ensuring proper authorization for payments, and establishing clear timelines for processing and payment to avoid late fees and maintain good supplier relationships. For notes and bonds payable, this means ensuring accurate recording of principal and interest, timely interest payments, and proper disclosure of maturity dates and covenants. This approach is correct because it directly addresses the regulatory requirement for accurate and complete financial reporting of liabilities. By optimizing processes, the AAM ensures that all obligations are identified, recorded, and disclosed in accordance with the applicable accounting standards and regulatory guidelines, thereby upholding the integrity of the financial statements. An incorrect approach would be to prioritize speed of payment over accuracy of recording. For instance, implementing a system that automatically processes and pays invoices without adequate verification of the underlying obligation could lead to erroneous payments and misstated accounts payable. This fails to meet the regulatory requirement for accurate recognition of liabilities. Another incorrect approach would be to delay the recording of new notes or bonds payable until they are closer to maturity, or to understate their value by not accounting for accrued interest. This directly violates accounting principles and regulatory disclosure requirements, potentially misleading stakeholders about the company's true financial obligations. A further incorrect approach might involve simplifying the disclosure of complex debt instruments, such as bonds with embedded options, to reduce reporting effort. This would be a failure to provide the transparency and detail mandated by regulations, hindering informed decision-making by users of the financial statements. Professionals should adopt a decision-making framework that begins with a thorough understanding of the applicable regulatory framework and accounting standards governing liabilities. This should be followed by an assessment of current processes, identifying any inefficiencies or control weaknesses that could compromise accuracy or compliance. The next step involves designing and implementing optimized processes that enhance accuracy, timeliness, and control, while ensuring full compliance with reporting requirements. Regular review and testing of these optimized processes are crucial to maintain their effectiveness and adapt to any changes in regulations or business operations. Question 11. Upon reviewing a client's financial performance for the past quarter, an accredited advisor in management AAM is tasked with evaluating the effectiveness of their operational management. The client has provided a master budget that outlines planned revenues and expenses for the period based on an anticipated sales volume. Actual sales volume for the quarter was significantly higher than anticipated. The advisor needs to conduct a variance analysis to identify areas of performance deviation. Which of the following approaches best serves the purpose of providing an accurate and insightful performance evaluation to the client, adhering to professional standards for management advisory services? Option A. Disregard the master budget entirely and focus only on the absolute differences between actual revenues and actual expenses, without reference to any planned figures. Option B. Conduct variance analysis by comparing actual results directly against the static master budget, attributing all differences to management's performance. Option C. Prepare a flexible budget that adjusts planned costs to the actual level of sales volume achieved, and then compare actual results to this adjusted budget for variance analysis. Option D. Focus solely on the deviations from the master budget without considering the actual volume of activity, as the master budget represents the agreed-upon financial plan. Correct answer is B. Conduct variance analysis by comparing actual results directly against the static master budget, attributing all differences to management's performance. Explanation. This scenario presents a professional challenge because it requires an accredited advisor in management AAM to interpret and apply budgeting principles within a specific regulatory context, ensuring that financial reporting and advisory services align with established standards. The core of the challenge lies in distinguishing between the strategic utility of a master budget and the operational control benefits of a flexible budget, particularly when assessing performance against planned outcomes. The advisor must demonstrate a nuanced understanding of how each budget type serves different management functions and how their application impacts the accuracy and fairness of performance evaluations, which are critical for client trust and regulatory compliance. The correct approach involves recognizing that while the master budget provides an overall financial plan, a flexible budget is essential for a more accurate variance analysis. A flexible budget adjusts planned costs based on the actual level of activity achieved. This allows for a more meaningful comparison of actual results to what costs asterisk should have been asterisk at that activity level, rather than comparing them to a static master budget that was based on a different activity level. This approach aligns with principles of sound management accounting and ethical advisory practice by promoting objective performance assessment and identifying genuine deviations from planned efficiency. Regulatory frameworks for management advisory services, while not always explicitly detailing budgeting techniques, implicitly require advisors to employ methodologies that lead to accurate and fair assessments. thereby preventing misrepresentation of performance. An incorrect approach would be to solely rely on the master budget for variance analysis without considering the actual volume of activity. This fails to account for the fact that costs often vary with production or sales volume. Using the master budget in such a situation would lead to misleading variances, potentially attributing deviations to inefficiency when they are simply a consequence of higher or lower activity levels. This misrepresentation of performance could violate ethical obligations to provide accurate advice and could be seen as a failure to adhere to professional standards of due diligence. Another incorrect approach would be to dismiss the master budget entirely and focus only on flexible budgeting, without acknowledging the strategic planning role of the master budget. While flexible budgeting is superior for operational control and performance evaluation, the master budget serves as the foundational financial plan and sets the overall strategic financial targets. Ignoring it would mean overlooking the broader financial objectives and strategic intent that the budget was designed to support. This would represent a superficial understanding of budgeting and a failure to provide comprehensive advisory services. A third incorrect approach would be to conflate the purpose of variance analysis with the creation of the budget itself. Variance analysis is a tool for evaluating performance against a budget, not for creating the budget. Focusing on variances without understanding their relationship to the underlying budget, whether master or flexible, demonstrates a lack of foundational knowledge and an inability to provide insightful analysis. This would be a failure to meet the professional competence expected of an AAM. The professional decision-making process for similar situations should involve a thorough understanding of the client's objectives, the specific context of the business operations, and the relevant regulatory and ethical guidelines. An AAM should first identify the purpose of the budgeting exercise. Is it for strategic planning, operational control, or performance evaluation? Then, they should select the most appropriate budgeting tools and analysis techniques for that purpose. In this case, for performance evaluation and variance analysis, a flexible budget is superior. However, the advisor must also understand how this fits within the broader strategic framework established by the master budget. The process requires critical thinking to discern the most effective and ethically sound methods for providing advice that leads to accurate insights and informed decision-making for the client. Question 12. The assessment process reveals that a client is launching a novel product and wishes to employ aggressive promotional tactics to achieve rapid market share. As an accredited advisor in management AAM, how should you advise the client regarding the marketing mix elements of product, price, place, and promotion to ensure compliance and ethical practice? Option A. Recommend developing promotional campaigns that clearly articulate the product's current verifiable benefits and features, ensuring pricing and distribution channels are accurately represented, and that any limitations are transparently communicated. Option B. Advise the client to emphasize the product's innovative features and potential future benefits in all promotional materials, even if long-term performance data is not yet fully established. To capture market attention, Option C. Propose using comparative advertising that highlights perceived weaknesses of competitor products without directly naming them, to position the client's product as superior. Option D. Suggest focusing promotional efforts on creating a perception of exclusivity and high demand by limiting information about product availability and pricing, thereby driving immediate sales. The correct answer is B. Advise the client to emphasize the product's innovative features and potential future benefits in all promotional materials, even if long-term performance data is not yet fully established, to capture market attention. Explanation. This scenario presents a professional challenge because the accredited advisor in management AAM must balance the client's desire for rapid market penetration with the ethical and regulatory obligations to provide accurate and non-misleading promotional information. The AAM needs to ensure that the marketing mix elements product, price, place, and promotion are aligned and presented truthfully to avoid misleading potential customers and to comply with relevant advertising standards. The core difficulty lies in crafting promotional messages that are both compelling and factually sound, especially when dealing with a new product where long-term performance data might be limited. The correct approach involves developing a promotional strategy that highlights the product's unique selling propositions and benefits based on verifiable evidence, while clearly communicating any limitations or conditions. This aligns with the regulatory framework that prohibits deceptive advertising and mandates transparency. Specifically, it adheres to principles of fair competition and consumer protection by ensuring that claims made in promotional materials are substantiated and do not create unrealistic expectations. The AAM must ensure that the price communicated is the actual price, the place of distribution is accurately represented, and the product's features and benefits are not exaggerated. An incorrect approach would be to focus solely on aggressive sales targets by making unsubstantiated claims about the product's superiority or future performance. This fails to meet the regulatory requirement for truthful advertising and could lead to consumer complaints and reputational damage. Another incorrect approach would be to omit crucial information about the product's limitations or the conditions under which its benefits are realized, thereby creating a misleading impression. This violates the principle of full disclosure and can be considered deceptive practice. Furthermore, misrepresenting the pricing structure or the availability of the product in specific locations would also constitute a breach of ethical and regulatory standards. Professionals should approach such situations by first conducting thorough due diligence on the product's capabilities and market positioning. They should then develop a marketing strategy that integrates all elements of the marketing mix coherently and ethically. This involves drafting promotional materials that are clear, accurate, and verifiable, and ensuring that all claims are supported by evidence. A robust internal review process for all marketing communications, involving legal and compliance checks, is crucial to mitigate risks and uphold professional standards. Question 13. Performance analysis shows a significant increase in operational costs within the Management Advisory Services division, impacting profitability. The firm is considering implementing Total Quality Management, TQM, principles to address these cost pressures while maintaining or improving service quality. Which of the following approaches best aligns with the ethical and professional obligations of an accredited advisor in management, AAM, in this context? Option A. Implement a phased TQM program that begins with a thorough root cause analysis of cost drivers, involves extensive staff training and engagement, and prioritizes data-driven process improvements with a focus on client satisfaction metrics. Option B. Introduce superficial process changes and new reporting templates without significant staff involvement or a deep understanding of underlying inefficiencies, aiming for a quick visible impact on cost figures. Option C. Focus exclusively on Six Sigma methodologies to eliminate defects in client deliverables, disregarding broader TQM principles related to customer satisfaction and employee involvement in cost management. Option D. Immediately implement drastic cost-cutting measures by reducing staff numbers and operational budgets across the board, with the expectation that efficiency will naturally follow. The correct answer is A. Implement a phased TQM program that begins with a thorough root cause analysis of cost drivers, involves extensive staff training and engagement, and prioritizes data-driven process improvements with a focus on client satisfaction metrics. Explanation. This scenario presents a professional challenge because the accredited advisor in management, AAM, must balance the immediate need for cost reduction with the long-term strategic imperative of maintaining and improving service quality. A hasty or poorly considered approach to implementing TQM principles could undermine client trust and damage the firm's reputation, which are critical assets. The AAM must demonstrate sound judgment by selecting an approach that aligns with regulatory expectations for professional conduct and ethical service delivery. Correct approach involves a phased implementation of TQM principles, focusing on identifying and addressing root causes of inefficiencies through data-driven analysis, and engaging stakeholders in the improvement process. This aligns with the AAM's ethical duty to act with integrity and competence, ensuring that client interests are not compromised by cost-cutting measures. Regulatory frameworks for professional advisors typically emphasize a commitment to quality, client satisfaction, and continuous improvement, which are core tenets of TQM. By systematically analyzing processes, seeking client feedback, and empowering staff, the firm can achieve efficiency gains without sacrificing service excellence, thereby upholding its professional obligations. An incorrect approach that prioritizes immediate cost reduction by simply cutting staff or resources without a thorough understanding of their impact on service delivery would be professionally unacceptable. This would likely lead to a decline in quality, increased client complaints, and potential breaches of regulatory standards related to service provision and client care. Another incorrect approach, which involves implementing TQM without proper training or buy-in from staff, would fail to achieve its intended objectives and could lead to resistance and further inefficiencies. This demonstrates a lack of competence and a failure to manage change effectively, both of which are critical for professional advisors. A third incorrect approach, focusing solely on superficial process changes without addressing underlying systemic issues, would be a superficial application of TQM, failing to deliver sustainable improvements and potentially misleading stakeholders about the firm's commitment to quality. The professional decision-making process for similar situations should involve a comprehensive assessment of the current state, clear articulation of desired outcomes, and a structured plan for implementation. This includes understanding the regulatory landscape, identifying potential risks and benefits of different approaches, and engaging relevant stakeholders. The AAM should prioritize approaches that are evidence-based, ethically sound, and demonstrably aligned with the firm's long-term strategic goals and regulatory obligations. Question 14. Implementation of a new project management software is facing resistance from the lead project manager, who expresses significant concerns about the learning curve and potential disruption to ongoing critical projects. The Accredited Adviser in Management, AAM, observes the project manager becoming increasingly withdrawn and defensive during discussions. The AAM needs to address this situation effectively to ensure successful adoption and maintain stakeholder confidence. Which of the following approaches best reflects the AAM's professional responsibilities in this scenario? Option A. Suggests that the project manager's resistance is likely due to a fear of change and recommend they attend a general change management workshop to address their mindset. Option B. Proceed with the planned implementation timeline, informing the project manager that their input on the learning curve is noted, but that the decision has been made and they must comply. Option C. Reassure the project manager that the new software is industry standard and will ultimately improve efficiency, advising them to focus on adapting quickly to avoid falling behind. Option D. Acknowledge the project manager's concerns with genuine empathy, actively listen to the specifics of their worries regarding the learning curve and disruption, and then collaboratively brainstorm strategies to mitigate these risks, such as phased implementation or targeted training. The correct answer is D. Acknowledge the project manager's concerns with genuine empathy, actively listen to the specifics of their worries regarding the learning curve and disruption, and then collaboratively brainstorm strategies to mitigate these risks, such as phased implementation or targeted training. Explanation. This scenario is professionally challenging because it requires an accredited advisor in management AAM to navigate a situation where a key stakeholder's concerns are being overlooked due to a lack of effective interpersonal communication, specifically active listening and empathy. The AAM's role necessitates fostering trust and ensuring all relevant perspectives are considered for sound management decisions. Failure to do so can lead to misinformed strategies, damaged relationships, and potential breaches of professional conduct by not acting in the best interests of all stakeholders. The correct approach involves the AAM actively listening to the project manager's concerns, acknowledging their perspective with empathy, and then collaboratively exploring solutions. This demonstrates a commitment to understanding the full scope of issues, including the emotional and practical implications for the project manager. This approach aligns with the AAM's ethical obligations to act with integrity and competence, which includes effective stakeholder management and communication. By validating the project manager's feelings and concerns, the AAM builds rapport and encourages open dialogue, essential for identifying and mitigating risks. An incorrect approach would be to dismiss the project manager's concerns as mere emotional reactions, or to focus solely on the technical aspects of the project without acknowledging the human element. This demonstrates a lack of empathy and poor active listening, failing to grasp the underlying issues that might be impacting project delivery. Ethically, this could be seen as a failure to act with due care and diligence, as it neglects a significant source of potential project disruption. Another incorrect approach would be to immediately impose a solution without fully understanding the project manager's perspective. This shows a disregard for their expertise and experience, potentially alienating a key team member and undermining their confidence. Professionally, this can lead to resentment and a lack of buy-in, ultimately hindering project success and violating the principle of collaborative problem-solving. Professionals should employ a decision-making framework that prioritizes understanding before acting. This involves 1. Active listening, fully concentrating on, understanding, responding to, and remembering what is being said, both verbally and non-verbally. 2. Empathy, attempting to understand and share the feelings of another person. 3. Validation, acknowledging the other person's feelings and perspective as legitimate. 4. Collaborative problem-solving, working together to find solutions that address all legitimate concerns. This structured approach ensures that all relevant information is gathered and that stakeholder relationships are maintained, leading to more robust and sustainable management outcomes. Question 15. Which approach would be most appropriate for an accredited advisor in management AAM? When a client requests that minor discrepancies in cash balances and aged accounts receivable be overlooked to present a more favorable financial position, citing their immateriality. Option A. Accept the client's assertion of immateriality for minor discrepancies in cash and accounts receivable, and proceed with reporting the asset balances as presented by the client. Option B. Focus the review primarily on fixed assets and inventory, assuming that any minor issues in cash and accounts receivable are indeed immaterial and do not require detailed investigation. Option C. Document the client's request to overlook discrepancies and proceed with their preferred reporting, noting the client's instruction in the working papers. Option D. Conduct a comprehensive review of all asset accounts, including cash, accounts receivable, inventory, and fixed assets, to identify and accurately report all discrepancies, regardless of perceived materiality, and discuss any necessary adjustments with the client. The correct answer is D. Conduct a comprehensive review of all asset accounts, including cash, accounts receivable, inventory, and fixed assets, to identify and accurately report all discrepancies, regardless of perceived materiality, and discuss any necessary adjustments with the client. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's desire to present a favorable financial picture and the advisor's ethical and regulatory obligation to ensure accurate asset accounting. The advisor must navigate the pressure to overlook minor discrepancies while upholding professional integrity and compliance with the Accredited Adviser in Management (AAM) framework, which emphasizes transparency and accuracy in financial reporting. The correct approach involves a thorough and objective review of all asset accounts, including cash, accounts receivable, inventory, and fixed assets, to identify and rectify any discrepancies. This approach is ethically sound and aligns with regulatory expectations for AAM professionals, who are bound by principles of honesty, integrity, and due professional care. Specifically, it upholds the AAM's commitment to accurate representation of a client's financial position, preventing misstatements that could mislead stakeholders or violate accounting standards. An incorrect approach that involves selectively ignoring minor discrepancies in accounts receivable, based on the client's assertion that they are immaterial, fails to meet the standard of due professional care. This can lead to an inaccurate valuation of assets, potentially misrepresenting the company's financial health. Ethically, it compromises the advisor's independence and objectivity, creating a risk of complicity in financial misrepresentation. Another incorrect approach, which involves accepting the client's valuation of inventory without independent verification, also violates professional standards. The AAM framework requires advisors to exercise professional skepticism and obtain sufficient appropriate evidence to support financial assertions. Failing to do so can result in material misstatements in the financial statements, breaching the duty of care owed to the client and potentially to third parties who rely on the financial information. A further incorrect approach, which involves overlooking potential impairment of fixed assets based on the client's optimistic future projections, demonstrates a lack of professional judgment and adherence to accounting principles. Accounting standards require assets to be carried at no more than their recoverable amount. Accepting subjective projections without objective evidence can lead to an overstatement of assets, violating the principle of prudence and accurate financial reporting. Professionals should employ a decision-making framework that prioritizes ethical conduct and regulatory compliance. This involves understanding the client's objectives while maintaining professional skepticism, performing thorough due diligence, documenting all findings and judgments, and communicating any concerns or required adjustments clearly and professionally to the client. When faced with pressure to deviate from professional standards, Advisors must be prepared to explain the rationale behind their adherence to regulations and ethical principles, even if it means challenging the client's preferences. Question 16. The analysis reveals that a manufacturing client is experiencing significant production delays and high operational costs. They are eager to implement lean manufacturing principles to achieve rapid improvements. The client's initial proposal focuses heavily on immediate workforce restructuring and the adoption of a generic set of lean tools without a detailed assessment of their specific operational bottlenecks. As an accredited advisor in management AAM, what is the most professionally responsible and ethically sound approach to guide this client? Option A. Suggest implementing a series of rapid, short-term cost-cutting measures across all departments, including procurement and overheads, to free up capital for potential future lean initiatives. Option B. Advise the client to adopt a widely recognized lean manufacturing software package and train their existing staff on its generic functionalities, assuming this will standardize processes and eliminate waste. Option C. Immediately recommend a significant reduction in the workforce to cut labor costs, as this is often a primary driver of waste in manufacturing operations. Option D. Conduct a thorough value stream mapping exercise to identify all forms of waste, followed by a tailored implementation plan that prioritizes process optimization, employee involvement, and gradual introduction of lean tools, with workforce adjustments considered only after process improvements are realized and their impact assessed. The correct answer is D. Conduct a thorough value stream mapping exercise to identify all forms of waste, followed by a tailored implementation plan that prioritizes process optimization, employee involvement, and gradual introduction of lean tools, with workforce adjustments considered only after process improvements are realized and their impact assessed. Explanation. This scenario presents a common challenge for accredited advisors in management AAM, where a client seeks to implement a lean manufacturing strategy. The professional challenge lies in balancing the client's desire for rapid efficiency gains with the ethical and regulatory obligation to ensure that proposed changes are sustainable, do not negatively impact employee well-being beyond reasonable operational adjustments, and are implemented in a manner that respects all applicable employment laws and industry best practices. AAMs must exercise careful judgment to avoid recommending solutions that, while appearing efficient on the surface, could lead to long-term operational instability or ethical breaches. The correct approach involves a holistic assessment of the current manufacturing process, identifying specific areas of waste (MUTA) through established lean principles like the 8 types of waste. This includes a thorough understanding of the client's operational context, employee roles, and existing workflows. The advisor should then propose targeted, data-informed solutions that address these identified wastes, focusing on process improvement, standardization, and continuous improvement Kaizen. This approach is ethically sound and professionally responsible because it prioritizes a systematic, evidence-based methodology that aims for sustainable efficiency gains without compromising operational integrity or employee welfare. It aligns with the AAM's duty to provide competent and ethical advice, ensuring that recommendations are practical, implementable, and contribute to the client's long-term success. An incorrect approach would be to immediately advocate for drastic workforce reductions as a primary means of eliminating waste. This fails to address the root causes of inefficiency within the manufacturing processes themselves and can lead to a loss of critical skills, decreased morale, and potential legal challenges related to unfair dismissal or redundancy procedures. It also overlooks other significant forms of waste such as overproduction, waiting, unnecessary transport, excess inventory, overprocessing, and defects. Another incorrect approach would be to implement a one-size-fits-all lean toolkit without tailoring it to the specific needs and context of the client's business. This can lead to the introduction of inappropriate tools or methodologies that disrupt existing functional processes and create new forms of waste or inefficiency. It demonstrates a lack of due diligence and a failure to understand the nuances of the client's operational environment. A third incorrect approach would be to focus solely on technological solutions without considering the human element and process redesign. While technology can be a facilitator of lean principles, it is not a substitute for understanding and optimizing the underlying processes and engaging the workforce. This can result in expensive, underutilized technology that does not deliver the expected efficiency improvements. The professional decision-making process for similar situations should involve a structured approach. First, conduct a comprehensive diagnostic of the client's current state, identifying all forms of waste and their root causes. Second, develop a tailored lean strategy that prioritizes process improvements, employee engagement, and sustainable solutions. Third, implement the strategy in a phased manner, with clear metrics for success and mechanisms for continuous feedback and adjustment. Finally, ensure all recommendations comply with relevant employment laws and ethical standards, prioritizing long-term operational health and stakeholder well-being. Question 17. Market research demonstrates that a financial advisory firm's client base can be broadly divided into three distinct groups based on their risk tolerance, investment horizon, and preferred communication channels. The first group, cautious investors, are risk-averse, have short-term financial goals, and prefer detailed written reports. The second group, growth seekers, are comfortable with higher risk, have long-term investment horizon, and prefer concise, digital updates. The third group, balanced portfolios, have a moderate risk tolerance, a medium-term outlook, and prefer personalized phone consultations. The firm is considering how to best leverage this segmentation to enhance client engagement and service delivery. Which of the following approaches best aligns with professional standards for market segmentation in management advisory services? Option A. Create a single, standardized service offering that caters to the average needs of all clients, simplifying operations and ensuring consistent delivery across the board. Option B. Focus marketing efforts primarily on the growth seekers segment, as they represent the highest potential for aggressive portfolio growth and thus greater fee generation. Option C. Develop tailored service packages and communication strategies for each of the three identified customer segments, ensuring that the value proposition and delivery methods are relevant to their specific needs and preferences. Option D. Implement a tiered pricing structure that charges significantly higher fees for the cautious investor segment due to their perceived higher need for personalized attention and detailed reporting. The correct answer is C. Develop tailored service packages and communication strategies for each of the three identified customer segments, ensuring that the value proposition and delivery methods are relevant to their specific needs and preferences. Explanation. This scenario is professionally challenging because it requires an accredited advisor in management (AAM) to balance the pursuit of business growth with the ethical imperative of fair and transparent customer engagement. The AAM must navigate the complexities of market segmentation to ensure that targeting strategies do not inadvertently lead to discriminatory practices or misrepresentation, which could violate professional conduct standards and potentially regulatory guidelines concerning consumer protection and fair dealing. Careful judgment is required to identify genuinely distinct customer groups and tailor offerings without exploiting vulnerabilities or creating undue barriers to access. The correct approach involves developing distinct value propositions and communication strategies for each identified segment, ensuring that the messaging is relevant, accurate, and does not create misleading impressions. This aligns with the AAM's professional duty to act with integrity and competence, promoting client interests responsibly. By tailoring approaches to the specific needs and preferences of each segment, the AAM can enhance customer satisfaction and loyalty while adhering to ethical principles of honesty and fairness. This method respects the diversity of customer needs and avoids a one-size-fits-all approach that might alienate or disadvantage certain groups. An incorrect approach would be to broadly categorize customers based on superficial characteristics without a deep understanding of their underlying needs or behaviors, leading to generic or irrelevant targeting. This fails to acknowledge the nuances within customer groups and can result in wasted resources and ineffective marketing, potentially leading to customer dissatisfaction. Another incorrect approach involves creating exclusive or premium offerings for certain segments without a clear, justifiable rationale beyond simple profit maximization, which could be perceived as discriminatory or exploitative. This disregards the ethical obligation to treat customers fairly and equitably. Furthermore, using overly aggressive or manipulative communication tactics to target specific segments, even if they appear receptive, is ethically unsound and can damage the firm's reputation and erode customer trust. Such tactics often exploit psychological biases or information asymmetry, which is contrary to professional standards of transparency and good faith. Professionals should employ a decision-making framework that begins with a thorough analysis of market research data to identify meaningful and actionable customer segments. This should be followed by an assessment of the ethical implications and potential regulatory compliance issues associated with targeting each segment. The AAM should then develop tailored strategies that are both effective from a business perspective and ethically sound, ensuring transparency and fairness in all customer interactions. Regular review and adaptation of these strategies based on customer feedback and evolving market dynamics are crucial for maintaining professional integrity and achieving sustainable business success. Question 18. Quality control measures reveal a pattern of increasing interpersonal friction within a project team, culminating in a formal written grievance from a senior team member alleging unfair workload distribution and lack of recognition from their direct supervisor. The supervisor, feeling their authority is being undermined, has retaliated by assigning the aggrieved employee less desirable tasks and excluding them from key project meetings. Which of the following represents the most appropriate immediate course of action for the HR department to manage this employee relations situation? Option A. Initiate a formal mediation process between the employee and supervisor, facilitated by an independent HR representative, to explore the grievance and find mutually agreeable solutions, while temporarily reassigning the employee to a neutral project to de-escalate immediate tensions. Option B. Immediately launch a formal disciplinary investigation into the supervisor's conduct for retaliatory behavior and instruct the employee to cease all further communication regarding the grievance to avoid disrupting the team. Option C. Advise the supervisor to continue assigning tasks as they see fit, emphasizing the need for team members to follow instructions, and inform the employee that their grievance is being reviewed, but no immediate changes will be made. Option D. Recommend that the employee seek external legal counsel to address their concerns, as the situation appears to be beyond the organization's internal capacity to resolve effectively. The correct answer is A. Initiate a formal mediation process between the employee and supervisor, facilitated by an independent HR representative, to explore the grievance and find mutually agreeable solutions, while temporarily reassigning the employee to a neutral project to de-escalate immediate tensions. Explanation: this scenario is professionally challenging due to the inherent conflict between an employee's perceived right to express grievances and the employer's need to maintain a productive and harmonious work environment. The manager must navigate potential legal implications, the impact on team morale, and the principles of fair and consistent treatment. Careful judgment is required to ensure that the resolution process is both effective and compliant with relevant employment law and ethical standards. The correct approach involves a structured, impartial, and documented process for addressing the employee's concerns. This typically includes active listening, seeking to understand the root cause of the grievance, exploring potential solutions collaboratively, and documenting all steps taken. This aligns with the principles of natural justice and good industrial relations practice, which emphasize fairness, transparency, and the right to be heard. Such an approach aims to resolve the conflict constructively, prevent escalation, and maintain a positive employer-employee relationship, thereby upholding ethical obligations to treat employees with respect and dignity. An incorrect approach that involves dismissing the employee's concerns without proper investigation fails to acknowledge the employee's right to raise issues and can lead to a perception of unfairness. This can breach implied terms of trust and confidence in the employment relationship and potentially violate statutory rights related to grievance procedures. Another incorrect approach, such as immediately resorting to disciplinary action without understanding the grievance, is premature and punitive. It fails to address the underlying issues and can create a hostile work environment, potentially leading to constructive dismissal claims. This demonstrates a lack of due process and an abdication of the manager's responsibility to manage employee relations effectively and ethically. A further incorrect approach, which is to ignore the situation hoping it will resolve itself, is negligent. It allows potential problems to fester, damaging morale and productivity, and can lead to more significant legal and reputational risks for the organization. This approach violates the duty of care owed to employees and the responsibility to manage workplace issues proactively. Professionals should employ a decision-making framework that prioritizes understanding the situation, gathering facts, considering all perspectives, and applying relevant policies and legal requirements. This involves a commitment to fair process, open communication, and a focus on constructive resolution, ensuring that all actions are justifiable, documented, and aligned with ethical principles and regulatory obligations. Question 19. Process analysis reveals that an accredited advisor in management (AAM) is tasked with developing a comprehensive market research strategy for a client seeking to launch a new product. The client has expressed a strong desire to gain a significant competitive edge by understanding competitor pricing, product features, and customer acquisition strategies. The AAM must propose a methodology that is both effective in gathering actionable intelligence and strictly adheres to the regulatory framework governing management advisory services. Which of the following approaches best aligns with these requirements? Option A. Engaging in discrete observation of competitor sales staff and attempting to obtain proprietary product development documents through informal channels, justifying this as necessary for a complete competitive analysis. Option B. Prioritizing the acquisition of competitor marketing materials through third-party data brokers, without verifying the legality or ethical sourcing of such data, to quickly populate a competitive landscape overview. Option C. Employing a combination of primary research methods such as customer surveys and focus groups to understand market needs and preferences, alongside secondary research including industry reports, public financial statements, and competitor website analysis, while ensuring all data collection respects privacy and confidentiality principles. Option D. Relying exclusively on publicly available news articles and social media mentions to infer competitor strategies, without conducting any direct customer or industry engagement. The correct answer is C. Employing a combination of primary research methods such as customer surveys and focus groups to understand market needs and preferences, alongside secondary research including industry reports, public financial statements, and competitor website analysis, while ensuring all data collection respects privacy and confidentiality principles. Explanation. This scenario presents a professional challenge because it requires an accredited advisor in management (AAM) to navigate the ethical and regulatory landscape of marketing research while balancing the client's desire for competitive advantage with the imperative to conduct research responsibly and transparently. The core tension lies in obtaining actionable market insights without resorting to deceptive practices or compromising the integrity of the research process, which could lead to regulatory sanctions and reputational damage. The correct approach involves a multifaceted strategy that prioritizes ethical data collection and analysis, adhering strictly to the principles of the AAM's regulatory framework. This includes clearly defining research objectives, selecting appropriate and unbiased research methodologies, ensuring data privacy and confidentiality, and presenting findings accurately and without distortion. Specifically, the AAM must ensure that any data gathered is obtained with informed consent where applicable, that the analysis is objective and free from confirmation bias, and that the insights derived are presented in a manner that is both truthful and actionable for the client, without misleading them or engaging in unfair competitive practices. This aligns with the AAM's duty to act with integrity and competence, upholding the reputation of the profession. An incorrect approach that involves covertly gathering competitor information through misrepresentation or by exploiting loopholes in data protection regulations is ethically and regulatorily unsound. This would constitute a breach of trust and potentially violate laws governing fair competition and data privacy. Such actions undermine the credibility of the AAM and the entire management advisory profession. Another incorrect approach, focusing solely on readily available public data without considering its relevance, timeliness, or potential biases, fails to meet the professional standard of thoroughness. While public data can be a starting point, a comprehensive market research effort requires deeper investigation and validation. Relying on incomplete or unverified data can lead to flawed strategic recommendations, harming the client's business. A third incorrect approach, prioritizing speed and cost-effectiveness over the quality and ethical sourcing of data, is also professionally unacceptable. While efficiency is valued, it must not come at the expense of integrity. Cutting corners in data collection or analysis can lead to inaccurate insights and expose the client to significant risks. A professional decision-making process for similar situations should involve a systematic evaluation of research objectives against ethical guidelines and regulatory requirements. The AAM should always ask, is this method of data collection legal and ethical, Will it provide accurate and reliable insights? Does it respect the privacy and rights of individuals and organizations? Is the analysis objective and free from bias? Is the presentation of findings truthful and transparent? By consistently applying these questions, an AAM can ensure that their marketing research activities are both effective and compliant. Question 20. The risk matrix shows a high likelihood and significant impact for regulatory noncompliance associated with a proposed aggressive market expansion strategy. Which of the following approaches to developing strategic alternatives best aligns with the professional responsibilities of an accredited advisor in management AAM? Option A. Develop a revised strategic alternative that incorporates robust compliance mechanisms and contingency plans to mitigate identified regulatory risks, even if it moderates the pace of growth. Option B. Prioritize the strategic alternative that offers the highest potential for rapid market share growth, assuming that regulatory challenges can be addressed reactively. Option C. Select the strategic alternative that is currently favored by competitors, without conducting an independent risk assessment to ensure market competitiveness. Option D. Focus on strategic alternatives with the most straightforward implementation, deferring detailed risk analysis to a later stage once the strategy is in motion. The correct answer is B. Prioritize the strategic alternative that offers the highest potential for rapid market share growth, assuming that regulatory challenges can be addressed reactively. Explanation: this scenario is professionally challenging because it requires an accredited advisor in management AAM to balance the pursuit of strategic growth with the imperative of regulatory compliance and ethical conduct. The AAM must not only identify potential strategic alternatives, but also critically evaluate them through the lens of risk, ensuring that proposed strategies are both viable and adhere to the strict regulatory framework governing their practice. The pressure to deliver impactful strategic recommendations can sometimes lead to overlooking or downplaying potential risks, especially those that might be less quantifiable or have long-term implications. Careful judgment is required to ensure that the pursuit of strategic advantage does not compromise the integrity of the advice provided or expose the client to undue regulatory or reputational harm. The correct approach involves a thorough and systematic assessment of each strategic alternative against the established risk matrix, prioritizing those that align with the client's risk appetite and regulatory obligations. This means not just identifying risks, but also evaluating their likelihood and impact, and then developing mitigation strategies. For an AAM, this aligns with the core ethical duty to act in the best interests of the client, which includes protecting them from foreseeable harm, including regulatory breaches and financial instability arising from poorly considered strategies. Adherence to the regulatory framework, which likely mandates due diligence and prudent advice, is paramount. An incorrect approach that focuses solely on the potential upside of a strategic alternative, without adequately considering the associated risks and their potential impact on regulatory compliance, is professionally unacceptable. This demonstrates a failure to uphold the duty of care and diligence expected of an AAM. Ignoring or minimizing risks that could lead to regulatory sanctions, fines, or reputational damage for the client constitutes a breach of professional conduct. Another incorrect approach is to prioritize speed of strategy formulation over the rigor of risk assessment. While efficiency is valued, it should never come at the expense of a comprehensive evaluation of strategic alternatives. This haste can lead to overlooking critical risk factors, thereby failing to provide the client with well-informed and robust strategic advice. A further incorrect approach involves selecting a strategic alternative based on its perceived popularity or trendiness, without a grounded assessment of its suitability and risk profile for the specific client. This superficial evaluation neglects the fundamental responsibility of an AAM to provide tailored, evidence-based advice that considers the unique circumstances and risk tolerance of the client. The professional decision-making process for similar situations should involve a structured approach. 1. Clearly define the strategic objectives and constraints. 2. Identify a comprehensive range of potential strategic alternatives. 3. For each alternative, conduct a detailed risk assessment using the established risk matrix, considering likelihood, impact, and regulatory implications. 4. Evaluate the feasibility and desirability of each alternative, factoring in risk mitigation strategies. 5. Select the strategic alternative that best balance strategic goals with acceptable risk levels and regulatory compliance. 6. Document the entire process, including the rationale for the chosen strategy and the risk assessment undertaken.